Hello, this is John Makarewicz, and welcome to the Multifamily Investor Playbook. So, a major piece of housing legislation just passed the House in the U.S. Congress, 396 to 13. I cannot remember a time when a bill passed with that much bipartisan support in likely decades. I didn't really look it up, but it's been so long that I can't even remember when something like this occurred. So basically, bottom line is that the housing crisis in the U.S. has gotten so bad, so politically undeniable that it's cutting straight through partisan gridlock. And in Trump's second administration, this is the only bill that has passed both the House and Senate. Now, we're going to get into a little bit. There are some variations between the House and the Senate bill, so there's still a little work to be done here. But the only one that is passing with largely across the board bipartisan support. So, just to be clear here, this bill is not a threat to apartment and multifamily investors or owners. In several real ways, it's actually a tailwind. So, we're going to break down exactly what passed, what changed between the House and the Senate version, and what it actually means if you own or invest in apartment communities. So, bill that just passed the House is the Road to Housing Act. Okay. So, the four things the bill does cover: first, it restricts large institutional investors, that is defined as operators that own 350 or more single family homes, from buying any additional single family rentals. So, groups like America Homes for Rent, Invitation Homes are now restricted once this bill becomes law from acquiring any new homes. Existing holdings do remain untouched. There were versions of this bill that would require them to start selling off these properties. But that has been removed. And I do think that's the right decision. These large institutional groups that own over 350 homes still own in the low single digits of the rental housing stock. The majority of rental housing stock is still owned by mom and pop owners, folks like maybe you and I that own a couple rental properties, perhaps, or maybe larger operations that own and operate, say, 50 to 100. That's where the majority of the single family rental housing stock is. And by the way, if they were forced to sell and all this inventory flooded the market, it actually might have very detrimental effects on values and just create more crisis than it would actually solve. So I think that was the right thing. It also reforms federal housing finance. So it raises and indexes FHA multifamily loan limits, which is great, and expands LIHTC, which is low income housing tax credit financing, through community banks. And it modernizes some programs that are already existing, and increasing the funding. It also streamlines federal permitting, which is huge, right? So there are some reductions in environmental reviews for HUD funded projects, and it adds infill residential to categorically excluded activities. So that's also good news. It also adds some renter protections, eviction helpline for residents or tenants in federally assisted housing, reporting requirements as well for large institutional investors. So Multifamily Dive, put an article out on this, and Francis Torres with the Bipartisan Policy Center had this to say: both chambers seem to want to pass a housing bill ahead of midterms, but are trying to do so thoughtfully, which candidly is somewhat rare in our politics today. So loving to see it. So what are some investor takeaways, right? So core provisions affecting multifamily investors. That SFR restriction will actually potentially have the impact of driving more renters towards apartments, because the stock of single family rentals will be restricted or reduced based on these large institutional investors being prohibited from acquiring new properties. We also have higher loan limits, which will be helpful, and permitting relief for new development. That's not something we do here at Ferris Capital Partners, but will have a positive impact. So this is moving toward passage with strong momentum, and investors should begin incorporating its likely impacts into property analysis and underwriting today. So let's talk about the build to rent provision, what it was and why it was removed. This was a great example of when politicians don't understand fundamentally how a certain industry works. So when a build to rent community is constructed, so when I say build to rent, this is a community perhaps of townhomes or single family homes designed exclusively to be rented. So an earlier version of the bill had a timeline in which, I believe it was 7 years, that they would have to start selling off those homes for sale and remove them from a rental option. But the reality is that when you do a build to rent project, it's like building an apartment building. You generally get a construction loan. And so it would actually be breaking the loan covenants to just onesie twosie sell off homes. So it was fundamentally unachievable, number one. But at the same time, I do believe that there should be good quality single family rentals and townhomes available for people that need that extra space, or maybe perhaps just want a yard or something like that. I think more option for residents and renters is a positive thing overall. So getting that out was a great decision. And basically, capital markets reacted immediately. Lenders and equity providers began pausing BTR projects with that 7-year forced sale, and so now we're starting to see things moving forward a little more, over the next coming weeks. So that's ultimately good news. So why did the industry push back? Right. So basically, 76 bipartisan House members sent letters to Speaker Johnson and the Minority Leader Jeffries warning that it would effectively halt nationwide production of BTR housing, which would actually have the impact of making the housing crisis worse. The White House itself also flagged some serious policy concerns with the Senate version. So that has been removed, right? So that's fantastic. In the House bill, it is removed entirely. There is still some meaningful restrictions based on that institutional investors at 350 plus homes cannot purchase additional single family homes. Once again, existing holdings remain intact. So that will be something where there will likely need to be, and it looks like the House has passed this, but a build to rent carve out. So that will need to pass the Senate, but that is moving in the right direction. So that's definitely something we like to see. Let's talk about the loan limits in permitting. It's a little less glamorous, but super important stuff. So with multifamily loan limits, this is like a 12-year overdue fix. So FHA insured multifamily loan limits haven't been updated in 12 years, while construction costs have greatly and dramatically increased. So loan limits have remained static. And so with that being updated, the House bill has raised those limits and indexes them to future construction cost gains. So there'll be automatic adjustments going forward. So we don't have to worry about, some other 12-year lag in the future. It's automatically going to update as construction costs rise, and those things will be indexed together. So the result should be more projects that currently can't access FHA financing will be able to do so. So what does that mean for investors in stabilized communities such that we invest it here at Ferris Capital Partners? So more supply capacity over the medium term, but the housing shortage is so severe, estimated to be somewhere between 1.2 to 5.5 million units nationally. I know that's a large range. It really depends on who you ask, but the National Association of Realtors is who I look at, and that number that they put out is closer to that 5.5 million. So for value add investors, the bill's demand side effects, SFR restriction, mortgage affordability challenge, likely more than offset any marginal supply impact. So they're also cutting some red tape, reducing some of the environmental and just federal permitting requirements just to optimize and allow groups to move forward more quickly. Infill residential projects added to categorically excluded activities, meaning no federal environmental review required. Now, to be clear, there are still state and local regulations that apply. So this was an effort to reduce the amount of regulations at the federal level to allow things to move more quickly at the state and local level. So it's not like these things are going away. It's just more so the federal government is stepping out of the way and letting the states and the local counties and cities make these decisions. So this is great, right? So very good news allows things to move a lot more quickly. So, some things were cut from this. At the end of the day, I mentioned the BTR thing. There was also something in the Senate bill that permanently authorized HUD's rental assistant demonstration program authorities. It was basically limiting their ability to convert units to project based assistance and unlock private capital for renovation. So, by getting that out of the way, that'll allow things to move a lot more quickly. So, these omissions are genuine policy losses, primarily in the affordable housing and disaster recovery space. So there are also most likely provisions to be restored in Senate reconciliation since the Senate passed some of these things with strong support. So we'll be watching that. So at the end of the day, how are we thinking about this, right? So market selection remains paramount. These bills provisions are most beneficial in markets with no rent control, landlord-friendly laws, and strong domestic in-migration. So that's exactly the type of markets we look at. Conventional multifamily has regulatory tailwind, institutional capital redirected away from SFR towards apartments. So that's a huge one. We'll be watching that closely. Loan limits rising and permitting streamlined. So this housing shortage remains the bedrock demand driver. And even with this bill passing, we're still going to see a lot of challenges towards solving this housing crisis. So at the end of the day, conservative underwriting doesn't change. Legislative tailwinds are great and they are in context, but not a substitute for disciplined acquisition. So we still want to buy well below replacement costs, approve livability, and operate for renewals. So this is a bit of a faster episode. Just wanted to update you on some things that are happening at the legislative level. If you're interested in learning more about what we do at Ferris Capital Partners, go to fulloutinvesting.com. You can see a sample deal deck as well as watch a video where we explain our full 10-step full out process from acquisition all the way to exit, as well as book a time if you'd like to learn more. Thank you so much for tuning in to the Multifamily Investor Playbook. We love and believe in you. If you enjoyed this content, please like and subscribe and share with another high net worth investor. Keep dreaming and investing big.